Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review why do you pay 115% interest on a 6% mortgage, and that's for a 30-year mortgage, right? So a lot of times, many people are not aware how to decipher how much you pay on a mortgage. So the bank or the lender usually have you focus on this low number, the APR, 6% right here. They might write on a quote or on the paperwork that, hey, you're eventually going to pay 115% interest or the total interest, but while you're getting the mortgage, they probably won't have you pay attention to it. And they'll have you focus on the low monthly payment. So before we do a deep dive, I'm actually going to just kind of show you why I put certain images on the thumbnail. So first of all, we have this fellow right here where it's like, where did the money go? The money's flying out of his wallet, right? And then here we have a person, or we have a home where it's like a +1 on a heartbroken homeowner. And then we have all this money that's just kind of flying out of the house. And so what happens is that a lot of people underestimate how much they can pay, or overestimate how much they can pay, and will underestimate how much they will pay in total for that mortgage, because when they see a low number like 3%, they don't understand like that's actually 50% interest, total interest you're going to pay after the end of 30 years, right? So when you do go 6%, that's 115% interest. Now, how do you know that? Well, you can easily verify this by doing a quick Google search. So I typed in bank rate, mortgage, amortization, right? So they have this cool thing called the amortization schedule calculator. And regardless of the amount that you put in, it's all going to be the same percentage-wise of how much interest you're paying. So if I put in 6%, you'll see that I pay about 115% interest. So you have a $100,000 loan amount, 115% interest. Now, if I put an extra zero, it's just going to be pretty much the same figure with additional, see, 115% in interest, right? So that's really what a 6% mortgage actually means, 115%. So let me just make that simpler. We'll make it $100,000. So over the cost of the loan, even though this low monthly payment is only $600, you're actually paying for two houses. You're paying for one house for yourself, which is the loan amount, and then another house to the bank, right? So think about that. And that's why a lot of people uh, have no clue why they're broke, because they're paying for two houses at a 6% interest rate. And there was a study done about how more than 80% of millennials regret buying their first home in 2023. And so you can see there's a lot of people out there who don't know what's going on. They're just excited to own a home because that's the American dream. And a lot of people who don't attain home ownership are kind of looked down upon. And so they'll do anything, quote, anything to be a homeowner, even overpay um, as much as $100,000. In fact, in that same study, it said 1 out of 7 millennials would gladly pay over $100,000 over asking price um, in order to get the home. And then they wonder why do most of them regret it, right? So here we have notice a $600 payment, $115,000 interest, and so it's like, how does it turn out that a 6% loan turns out to be 115% interest? And that's because you need to know the whole story, right? You're making payments over 30 years. And so the longer the loan is, the more interest you pay. So if you pay, let's say it's a 10-year loan, yeah, the payment amount might be higher, but the bank actually makes less money. Interesting, isn't it? Like some people would think like, oh, if you pay the bank more in a loan or overpay it, they'd actually like that, or that might raise your credit score. That's probably the reverse, because they're not making as much money off of you. And banks like people who are not broke, but who certainly will not pay off their loans that quickly. And so you might be aware that um, people who pay off their loans quickly don't have as high of a credit score as people who just pay on time. All right. So here we have a mortgage payment formula. So here's the thing. Out of all the things related to the calculation of mortgage, the most complicated thing is this monthly payment. So I would suggest you look up the formula, put in the numbers, see how to calculate the monthly payment. I'm a little bit lazy. I just like to use the website calculators like Bankrate or Carl's Mortgage or just the Google Mortgage calculator. There might be some rounding, right? So just be aware that the figures may not be exact. But let's go back here. So in order to calculate the monthly mortgage payment, Basically, you put in P, which is the amount you're borrowing, I, the interest rate, so that'd be that 6%, N is the number of payments. So if it's a 30-year loan, it'd actually be 360. And so you calculate that, and then that'll be about $600 a month at a 6% on a $100,000 principal. Now, to calculate, so this is what happens. If you look here, your payment gets split into two things. So one is the principal, which is the actual amount of the loan you're paying off, and then one is the interest. So the interest is what you could just think of the bank's profit, right? So as you can see, in the very beginning of a loan, most of it is just profit to the bank, and that's how the long amortization schedules really benefit the bank. It looks like it benefits you because you get a lower monthly payment, but banks like that even more because they're making a lot more interest in what they lent out, right? So that's how that 3% loan becomes 15%, and a 6% loan becomes 115%. So it's really crazy. So we're gonna just do a quick breakdown of how these payments are split, and it's really, really easy. So all you have to do is you take the balance of the loan. So let's say we're starting off and we have a $100,000 loan, and then you multiply it by the interest rate, which is 6%, and then you divide by 12 because this interest rate is quoted annually, and since they charge interest every single month, you just have to divide that by 12, and then you'll get the interest payment, right? So let's go ahead and figure that one out. So 100,000 times 0.06 divided by 12. So that means $500 is going to interest, right? So $500, that's insane. Oopsie, is going to interest. And so what you do is you take that monthly payment, and again, some of the figures might be off a little bit just because there's probably some rounding. So monthly payment minus interest payment equals principal payment. Okay, so what does that mean? So 600 minus 500 equals $100 principal payment. So now what you do is you subtract this from the balance of the loan. So 100,000 minus 100 would be 99,900, new next month's balance. And then you just repeat the same formula over and over again. So it's kind of like a deception, but let me just kind of do the next month. So 999, and then what you do is you do this, multiply it by 0.06. So 99,900 times 0.06 divided by 12, and that's about almost $500. So 499.50 of interest, right? So that's the interest payment. And then we just kind of repeat and rinse and repeat again. So 600. Now, again, some of my figures may be a little off just because I noticed that Bankrate does round sometimes. So 499.50. And then that'll be the next amount of principal that we shaved. So minus 600. So we shaved off $100.50 in the next month. And then we just repeat over and over again. So what we do is that we take this number for the next month's balance and then minus this. So 99,900 minus 100.5. And then so the next month's balance will be this. Will be next month's balance. And then we read, so think about this. Because you have a very low monthly payment which actually benefits the banks, and you have a very large balance, you're multiplying the interest with that very large balance. That's why the principal is so little of it is shaved off every single month. And then when you do this 300, repeat, rinse and repeat 360 times. And as I said before, the bank makes more money when they have a longer loan and a lower monthly payment than a higher payment and a shorter loan. That's where the money and interest and time profit is for the bank, right? And so that's how this 6% loan eventually becomes 115% loan, because you're taking a large balance, putting an interest rate, and then subtracting it with a small monthly payment. Now, obviously, if you overpaid, then it would just be a shorter schedule. But most people are not going to overpay a loan because they know that their liquidity is gone. So that's why if you keep going down here, down, 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 so we see the 500, 499.50, and then it only goes down 50 cents, which is ridiculous. Every single payment, that's why you pay so little into the principal, and it's mostly gone to interest. And you just repeat that 360 times. Now, eventually, if you go down here, yes, you will pay off that principal, but look at how much interest that you paid. And so after 30 years, you thought you were paying for one house, but you're actually paying for two. So that's why, that 6% mortgage eventually becomes 115%. And funny story, I showed this to two people who are older than me, and it really discouraged them from buying a home. I didn't even say like, don't buy a home. I was like, this is just how a mortgage works. And they're like, yeah, I don't want to buy a home anymore. If I'm going to buy it, I'm going to buy it smart, right? And that's what you have to learn how to do. You have to learn how to buy a home smart, meaning that you don't pay retail. You have to essentially get a discount. And all real estate investors should seek to get a discount, although you don't necessarily have to most of the time or some of the time, but most of the time you should seek to get a discount. All right, so this is Creating Atlanta Mentorship. If you're interested in joining a group, go ahead and click the Google form link below, or go ahead and email us at the, you can find our email address in the About page on the YouTube channel, and just say that you're interested, and we'll just reply and set up a time for a call, see if you're a good fit. All right, have a great day, everybody, and we'll see you next time.